Hey everybody, welcome back to the Investing Circle where we talk all things financial independence and making your money work for you. Today we're talking about rising interest rates, which I'm sure everybody is paying attention to. Now, the Federal Reserve continues to raise interest rates in an effort to combat inflation, which is also in the news. Now, the one piece people are probably missing is the fact that it does impact your debt and your savings, and in today's video we'll talk about that. The first piece we need to start with is interest rates and debt. Interest is the cost of borrowing money for things like a mortgage, an auto or personal loan, or using a credit card. When interest rates are increased, the cost of borrowing money increases too, as consumer banks typically follow the Fed and raise the APRs, the annual percentage rate on loans. The cumulative 2.25% hike so far in 2022 means that for every $10,000 you have in your debt, you're paying an extra $225 than you were in 2021. With inflation the highest it's been in 4 decades, hovering around 9%, it's been a double whammy for a lot of consumers. Now, there is a bright side to rising interest rates. Just as consumer banks raise APRs, they also raise APYs, which is annual percentage yield, which we talked about in another video, and I will link that in the description below. APY is the interest paid on deposit products like checking and saving accounts. Remember, high yield savings accounts are the key ones because typically you have an APY that's higher than most banks. Now, don't get too excited because APYs will rise at varying speeds and not all banks will implement the increase. Frankly, even if the APY rises 2%, that's nowhere close to inflation, which again is around 9%, which is another point that we talked about before where you want to actually invest your money somewhere that it's not just losing value. Inflation erodes the buying power of the dollar. What cost $1 last year cost $1.09 now, and every dollar you have in a bank account with a 2% APY is worth just $1.02. Now, this is where prioritizing financial goals comes into play. If you don't currently have an emergency fund, that should be your priority. An emergency fund is the best way to stay out of or avoid adding any kind of credit card debt. A fully funded emergency fund will contain 3 to 12 months worth of essential expenses. That's a tall order and does take time to accumulate. Building a fund of $1,000 is a great start though. Many of life's emergencies clock in at under $1,000. Paying off high interest debt like credit card debt is the next on the list. While getting out from under that sort of debt is always important, it's even more so when interest rates are climbing. With every Fed hike, that debt is getting more and more expensive. As you can see, there is a pro and a con to this rising interest rate issue. Now, how to actually pay off that debt can be a really fun thing to figure out. A debt consolidation loan can be the fastest way out of high interest debt. The reason it takes so long to get out from under credit card debt is due to the high interest rates. The average interest rate on a credit card ranges from the mid to high teens. I'll also link where I'm getting that information from in the description below. Having debt doesn't necessarily mean having bad credit. If your credit score is high enough, you may be eligible for a personal loan with a lower interest rate than your credit cards. Generally, those with a score of 760 or above will be offered the best rates. Now, you can check your credit score at sites like Credit Karma or Credit Sesame. You do normally use the loan to pay off the credit card, reducing the cost of your debt. Banks, credit unions, and online platforms like Lending Club offer personal loans. You can often window shop for interest rates without committing or requiring a hard credit pull, something that lowers your credit score by just a few points if you're not familiar with that. Just to be sure, read the terms for things like fees and early repayment penalties. If a loan is not an option, you can still tackle debt, but you need some type of strategy. There are 2 great debt payoff strategies, snowball and stacking. The first method is the snowball method. This is as simple as listing all of your pressing debts according to the amount owed, lowest to highest. Pay as much as possible on the first while paying just the minimum required payment on the rest. When the first debt is paid, you use the money you were paying on it and put it towards the next on the list, continuing to pay only the minimum on the rest. Continue on the way down until you've paid off the very last debt. The stacking method is the second method, and that's essentially the same as the snowball method with one key difference. List the debts according to the interest rates, highest to lowest, and work your way down the list. Which method is best out of the two? From a strictly money saving standpoint, the stacking method is superior. The interest rate is the cost of borrowing money, so the higher the rate, the more expensive the debt. And the stacking method eliminates the highest interest debts first. But humans are not always rational, especially when it comes to money. The snowball method can provide a lot of quote-unquote instant gratification if one or few of your debts are relatively low dollar amounts. And those quick wins can help you stay motivated to just keep on getting rid of your debt. Now, the very last piece is just to remember to tighten your belt, so to speak. Inflation and interest rates are both heading in the wrong direction for consumers, and that doesn't look to be changing anytime soon. If you have high interest debt, now is the time to buckle down and pay it off. If debt isn't a problem for you, then it's time to take advantage of these rising interest rates and grow your emergency fund. Thank you for watching the video, everybody. If you like this type of content, go ahead and press like and subscribe to the Investing Circle. Please check out our website, which is always growing in investing community. And if you have any ideas on what you'd like to see on the channel or in the site, please leave a comment below. See you later.